I'm Michael Rupert. I'm not a guru. I'm a quantitative analyst, a mathematician. I have a bachelor's degree in mathematics, a master's degree in data science, and have completed doctoral coursework in computational mathematics. I built Olympia because I wanted a tool that strips the emotion out of trading and instead focuses on logic and historical probability. Today's lesson is the one almost nobody teaches. When do you actually sell and exit a trade? Everyone teaches the buy. Almost nobody teaches the sell. And the sell is where accounts actually die. This particular one is Apple, AAPL, swing. Start to finish. By the end, you'll see the whole exit plan. The whole point, every line was decided before the trade was on. Not in the heat of the moment, in advance. Getting in is easy, but knowing when to get out is everything. Quick vocabulary before we dive in. These are terms you'll hear me use, and I'll explain each one again as it comes up. You don't have to memorize. They're right here on this slide for ease of reference. The capital letter R just means your risk. Reward to risk is what you're trying to make versus what you're willing to risk. ATR is average true range, is a stock's normal daily wiggle from high to low. Support is floor. At some time in the past, there was a floor. Resistance is the ceiling, like the upper limit, the highest it's gone in the past. That's the whole vocabulary. Everything on that card. No jargon walls. Let's get into it. So here's the entry. 284. This is exactly where most people stop planning. They buy, then they say, let's see what happens. That's not a plan. That's a hope with money attached to it. A trade with no preset exit isn't a trade. So let's build the plan, starting with the number that caps your downside. There's multiple exits. The first one we're going to talk about is the stop. We're going to set the stop at 274. That's the most I'm willing to lose on this trade. I've decided that up front. From 284 down to 274, I only want to lose $10 a share. R is $10. That's my risk. That is what I want to risk. 1 unit of risk for me is $10. R just means risk. It's the ruler we use to measure the whole trade by. The magic isn't the number, it's the timing. I picked my worst case. And for me, at this time, I'm calm and I say, I don't want to lose more than $10 per share. I'm not doing it later. I'm not doing it while I'm bleeding. I'm setting the stop now, and I'm not doing it out of fear. I'm picking a number I'm comfortable with. I'm setting it. I'm being logical about it, and I'm done. That's my stop. That's what I'm willing to lose. Now you might be thinking, Mike, why 274? Why not some other random number? Well, this is a fair question, and here's the honest answer at 3 levels. Level 1, if you're a beginning trader, you put the stop just below support. Support is the swing low, where the stock already bounced off of. Support is a floor, where buyers stepped in before and price bottomed out and began increasing. If price breaks back under that floor, the whole reason you bought the stock is gone. You're out. You're here to make money, not lose money. Now, if you're a novice trader and the gap is your risk, 1R, which was $10, and both your target and your position size get measured from that. So if you want more risk, you can calculate it more than 1R. So maybe it's 2R, maybe it's 1.5R. Your R is 10, so now you can set that. Now, if you're an advanced trader, you can size the buffer with volatility. And the volatility you can use is ATR, average true range. It's the average amount a stock moves in a bar. It's normal wiggle. Put the stop about 1.5 times that below your entry. So the noise doesn't stop you out, but a real break does. Bottom line, a stop isn't what you can afford to lose. It's the price that proves you wrong. Okay,
Now the trade's working. As price climbs, I set my first target at 304, which is a reward to risk ratio of 2 to 1. Remember, I already decided what my reward to risk was going to be before I got into the trade. I felt a 2 to 1 reward to risk was a good trade. The second it's there at 304, I'm locked in. Plus $20. That's plus 2R or plus 2 my risk. 2 times what my risk was, twice my risk. This trade cannot go red anymore. Now, how do I actually keep it from going red? How do I hold on to that gain? I use something called a trailing stop. A stop that only goes up, doesn't go down. It rides a set percentage below the price. But here's the catch most people miss. A trailing stop sits below the peak. So the stock has to climb a little past the 304 for my stop to pull up. How far past depends on how tight I set that stop or that trailing stop. 2% trailing stop, the stock is going to have to reach about 310. And then a 2% dip pulls my stock up to 304 and locks the $20. A 3% trailing has to hit about 313, and a 5% trailing has to hit about 320. Tighter trails lock it in sooner but get shaken out by small wiggles. Wider trails let it run faster but give more back. Either way, the stop only ratchet up. It never gives ground. The most painful thing is in trading is watching a green winner bleed all the way back to a loss. A winner turning into a loser is a decision. The trailing stop makes that decision for me automatically. Okay, back to the original slide. Now we're at our third exit, and I'm just going to continue where we were on this slide and keep it simple. The target was 314. That's the third exit. That is plus 30 or 3 times my risk. There's the whole equation. You have R to R, and I risked 1R to make 3. I have a risk to reward of 3 to 1, risking $1 to make 3, and I knew it before I ever clicked buy. 3 exits, 3 jobs. The stop caps the loss. The trail protects the gain. The target books the win. None of them were done emotionally. All of them were just math I wrote down in advance, and I showed you how to calculate how much farther you need to go above that risk, that reward to risk. So your targets are actually a little higher depending on the percentage of the trail that you want. If you want that full 3 to 1, then you're probably going to have to target much more than 314, maybe 330. Maybe you want a 2% trail. Maybe you want a 3% trail. You can calculate all that from the slide before this one. So you're going to ask me, why 314? 2 honest ways to pick a target, and the best trades use both. If you're a beginner, you want to aim just under the ceiling or resistance, the prior high, or a round number where price tends to stall. Resistance is the ceiling where sellers stepped in before. Sell into strength instead of hoping the signal will break through. If you're a novice, make it pay. Target 3R, 3 times your $10 risk, which lands right at 314. Rule of thumb, skip anything paying less than about 2 to 1. If you're advanced, when the math number and the real chart level line up, that's your best odds exit. Or scale out, bank some at plus 2R and trail the rest for the big runners. 2 ways to pick a target, the math and the chart. Take the trade when they agree. Here's the finished picture. Every line, every number, all locked in before the trade went live. Entry 284, stop 274, risking 1R. Trail to 204, locking 2R, target 314, booking 3R. A clean 3-to-1 plan. Now, look at what's missing. No fear, no hope, no, let me just see what happens. That's absent. That's the entire edge. Everything else is noise. And that's actually something we programmed into Olympia as well. It will actually calculate your trails, your targets, and tell you exactly what to look for so that you don't have to do the math. You can be very unemotional about it. You just follow what it says, and it picks it for you. For whatever signal you look at, it'll give you that information. You just got to enter it on whatever platform you use, and you're good to go. This is the whole philosophy. You're not smarter than the market in the moment. Nobody is. The moment is where fear and greed live. So you move the decision out of the moment. Decide all 3 exits before you're in. Price hits a line, you act. No debate. That's how you protect your capital and stay emotionless. Not by being tough, but by having already decided. That's exactly what Olympia does. It's why I built it that way. The models flag the setups and the exits, so you're always trading a plan, not a feeling. The daily briefing is free. The setups and when to get out are at olympiiqtrade.com.